since interest rates first really surged higher about a year ago, one of my absolute favorite stocks, Kinder Morgan Energy Partners, that's KMP for you home gamers, it's just been hammered. Kinder Morgan is the largest pipeline operator out there, tens of thousands of miles of pipe for all oil, gas, and refined products, carbon dioxide, the latter being an important ingredient needed for hydraulic fracturing. Now, you know we're experiencing an oil and gas renaissance in this country. I talk about it all the time. And regular viewers know that the more oil we produce, the more pipeline capacity we need to take it from the wells, which are often in the middle of nowhere, to the places where it can be refined. So it's no wonder that Kinder Morgan has a $16 billion backlog of new projects that can fuel the company's growth for years to come. But until about a month ago, the market was treating the stock like a punching bag, in large part because it's a high-yielding master limited partnership. In other words, people have been owning stocks like Kinder Morgan as bond market alternatives. So when bond yields started rebounding last year, a lot of investors who own MLPs began to sell them hand over fist. They kept on selling them, particularly this one, even when bond yields began to come back down. However, now it's looking like Kinder Morgan may have bottomed roughly a month ago. Stock has rallied nearly 6 points since then, and even after that move, it supports a gargantuan 7.1% yield. Plus, the company reported last Thursday, and the numbers were terrific, with distributable cash flow coming in at $1.55 per share, 6-cent beat, and the overall backlog rising by $1.6 billion. Can this stock regain its loss? It's really old luster, let's put it that way. Let's take a closer look with Rich Kinder, the bankable chairman and CEO of the whole Kinder Morgan family of companies. Mr. Kinder, welcome back to Mad Money.
Thank you, Jim. It's good to be here.
All right, Rich, there's some people who are saying that not enough value these days is being unlocked by your company, that it's gotten too big and that Kinder Morgan can no longer give us the growth we've been used to over the fabulous last 17 years. What do you say to the critics who are saying, you know what, better days behind them?
Well, you know, I look at the long run, Jim, and I think in the long run, markets are very stable and very predictable. In the short run, they can be very erratic. What we have is a tremendous growth platform. As you said, we have a $16 billion plus backlog of projects that we'll be bringing online over the next 3 to 4 years. We have a tremendous position, particularly on the natural gas side. You know, natural gas is going to grow from a little over 70 BCF a day today to about 95 BCF a day within the next 10 years. If you just read Wood Mackenzie's new outlook, and that's pretty typical, we're going to be right in the middle of that and overlooked, I think, in our first quarter. I tried to stress it, but I guess I'm not that good a communicator. We signed new long-term contracts averaging 15 years in duration for 2.8 billion cubic feet a day on our Tennessee and El Paso natural gas systems. So we're blowing and going. We think we have lots of room for growth left.
Well, let's go over that because I think, again, I think you and I are on the same page, Rich. I've known you for a long time, and the underperformance has mystified me because you've got real good growth. People have been favoring enterprise, which doesn't necessarily have the good yield like you do, and it's a consistent operator, but they have a lower cost of capital. Is it a problem to have a higher cost of capital in this business? And also, should we worry because you got $5 billion in floating debt? What I'm looking for is the explanation that I can't find about why people aren't buying yours over others that I think aren't as good as yours.
Well, I would never comment on any other company, Jim, but we think we have a great platform. I don't have the explanation as to why people over the last 6 or 8 months have not been buying us, but I think part of it is the feeling that we're too big to grow. You know, if you put all of our companies together, our enterprise value is a little over $100 billion, and so people say, well, they can't keep growing. We've said repeatedly this year we're going to raise our distribution at KMP by at least 5%, and we've said at KMI we're going to raise it by at least 8%. Now, truthfully, we're doing a little better than our budget at this point, and we would hope to do a little better than that. But if you just look at that, at KMP, we have a yield of 7%, a little over, and if you can get 5% growth, you got a very nice return. At KMI, we've got 8% growth and a 5% yield. So we think we're a compelling story, and we've reaffirmed our guidance for the year. Furthermore, we've said that if you use 13 as a base year for the next 3 years, we will average 5% growth at KMP and 8% compound growth at KMI. To me, just as a simple old pipeliner, those are pretty damn good figures. I own 23% of the company at KMI, and I'm very happy. In fact, as you know, I bought more over the last few months.
Yeah, I know. Do you think one last question on just trying to get at what people are getting at? I know you sounds like I'm devil's advocate, but I got to get it. Do you feel you have enough coverage? Because there are a couple quarters where you do not necessarily have as much coverage as other companies in your industry.
Well, I think it depends on the mix of assets. We will always cover our distribution and then some. In fact, this year our coverage is running very strong, as you know, in the first quarter. And first quarter is always strong for us, but we had $75 million of coverage, or as you put it, we had $1.55 of distributable cash flow per unit and distributed $1.38. So we will have excess coverage. I think that a company as big as we are, with as diverse set of assets as we have, frankly, doesn't need to have as much coverage as somebody does that has more commodity exposure, more risk, and a much smaller operation. So we're very comfortable with our level of coverage, and it will always be in excess of one.
Well, Rich, I am too, and I find it mystifying. To me, I've been saying on the show, it's just such a buy, and everything you just told me just verifies that. And I think that KMP is the cheapest in the group. I want to thank you, Rich Kinder, for coming back on Mad Money.
Thanks, Jim. It's always a pleasure to be with you.
Excellent. Thank you. That's Rich Kinder, Kinder Morgan's chairman and CEO. Look, is it done as well as Enterprise? No. Is it done as well as some of the others? No. Is KMP less expensive? I think it is. Is the growth there? I think it is. Is the coverage there? I think it is. I'm with Rich Kinder on this. I think you should be with Kinder Morgan. Stay with Cramer.